We're here in Monte Carlo for the Rendez-Vous de Septembre. For AM Best TV, I'm Richard Banks. And I'm joined now by Greg Carter, who's Managing Director, Analytics for EMEA, Asia-Pacific, AM Best. Greg, welcome.
Thank you, Richard.
It's a lot of talk here in Monte Carlo about the inflationary situation. How are reinsurers reacting to that?
I've been very surprised. It's been top of the agenda for many of the companies that we've met during the rendezvous. And what is clear is no one's got a clear picture of what to do about it. It's the elephant in the room, but no one's quite sure how things are going to develop. And clearly, we've seen inflationary pressures rising for more than a year now. The early rise in inflation was initially described as likely to be transitory. What's been clear is it's far from transitory, and the Russia-Ukraine invasion has really added fuel to that fire, and we're seeing a tremendous crunch now, particularly across the Eurozone. One of the factors that we have seen in terms of trying to address inflation, the Fed moved far earlier than the ECB. The ECB really only moved last week, and what that did is add further fuel to that fire, because as the Fed raised rates, we saw the dollar strengthening and the euro weakening. And effectively what that did was export inflation from the US to the Eurozone. So what was already a challenging situation has become even harder. Now, for reinsurers, the challenge of dealing with that is enormous, because clearly the costs of claims, repairs, the goods, microchips, etc., everything is getting more expensive, and trying to factor that into premiums collected today for claims that are going to come in over the course of the next 1 to 5 years is extremely difficult, and no one seems to have a clear picture of what to do about that.
Part of the problem is also, I guess, the difference in financial exchange, in the exchange rates. So how does that play in? How significant is that?
Well, the larger companies generally, they do play across multiple currencies. They have liabilities in multiple currencies. And whilst a lot of premium is defined in dollar terms, obviously the underlying risk can emerge in that local currency. So it's an issue that companies are very well aware of. They model currency fluctuation, and they match assets and liabilities wherever possible. So for companies that have been on top of that matching risk and follow a careful strategy, it shouldn't make much of a difference. Where we have seen an impact is, of course, in reported numbers. And whilst companies are using current reporting formats, you're going to see that shift in assets and liabilities that don't necessarily move in line. IFRS 17 will take some of that away. And in effect, today, Solvency II does give companies scope to account for that. So what you see in terms of some of the currency movements are largely, they're theoretical. They're not economic in that sense. So you need to look beyond some of the headline numbers. Now, for any companies that aren't closely managing that currency risk, then they do have a greater exposure. Our view is that when you look across the top 50 reinsurers in the world, those companies are generally well sophisticated in their techniques for dealing with currency exposures. So at this point, we're not overly concerned about those movements.
Even with companies without a big FX exposure, there's still asset volatility. What effect is that having on risk-adjusted capitalization?
Well, again, it depends on how you're measuring that and how that's being reported. From an economic perspective, we're not seeing companies suffer, because they have generally matched asset and liability by duration, as well as currency. So whilst you may be seeing a reported movement in their capital position, the true economic position has not worsened. And in fact, the underlying profits that companies are generating on business has led to a number of companies reporting stronger Solvency II capital positions.
And in terms of capital raising, what's the situation out there? How are we looking?
That's a very interesting situation, because with rising interest rates, raising capital is a difficult subject, and particularly when we look at softer forms of capital, so particularly the debt markets, we're seeing really not much action there, because in a rising interest rate, investor demand is not there. If you know that you can buy a bond with a greater yield in 3 months' time, then why buy an instrument today at a lower yield? So I think that market is not necessarily dried up, but it's certainly there's a lower interest from investor appetite right now.
Greg, thank you very much indeed.
Thank you, Richard.
For AM Best TV, I'm Richard Banks.